Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we're taking a look at triangles and wedges. Well, let's first define what they are. A triangle is exactly what it sounds like. It is a triangle shape or pattern. So what you get is you get the markets bouncing back and forth in an ascending and descending trend line. And eventually you get a breakout. Now, this is a symmetrical triangle, which means it's an even fight, if you will. And then eventually, once you get the breakout or the breakdown, you follow. There is an ascending triangle, which shows more buying pressure because they're buying at higher levels. And then there is the descending triangle, which shows that sellers are coming in a little bit more aggressively. The beauty of these triangles is that they have a measuring stick. It's basically the height of the stick or the triangle. So in this case, you would aim for that much. So say it's $1, you aim for $1. $1 here, $1 in either direction here if it's all the same height. Wedges aren't quite triangles, but they are a tightening of the market. So a wedge might look something like that. Market's banging around on the inside. They tend to break in the opposite direction, so it's an ascending wedge. You're looking for a breakdown or a breakout on a descending wedge. You aim for the bottom of the wedge. In both instances, you put your stop loss on the other side of the pattern. So with that, let's take a look at some charts and see what we can find. I see one immediately here on City 30-minute chart. You can see that there was support there previously. We break to the upside. The height of this is basically $1. It's like $1.02. And you can see we hit that almost immediately at the breakout point. So you measure it from there. Stop would have gone on the other side of the triangle. As I go looking for other patterns, keep in mind that this is on the fly. So this shows you just how common they are. Here's a wedge, an ascending wedge. We broke down through there. We not only hit our target, but we went much lower, obviously. And in fact, there was another wedge here, which we also hit our target. Here's an ascending triangle. And it comes down to whether or not you count wicks on this one, because we didn't close below there. So that comes down to your aggressive or risk appetite, if you're aggressive or not. You can make a case for a wedge there. We hit and then turned around and formed this triangle. I mean, that's how often they happen. Let's go ahead and take a look at, say, JP Morgan, 30-minute chart as well. I'm sure I can find plenty on this if I spend a few minutes. So I could make a case for a descending wedge there, which did in fact hit the top. There's definitely one there. So there are a couple of filters that you can use. One thing that a lot of people like to do, and this is especially true with triangles, and it doesn't matter the triangle, but they want to see at least 20% to the apex still unfilled when we break out. Because what can happen is you can go through the triangle and simply go sideways. That does happen. But as a general rule, this is a filter that some people will use. Wedges, people don't tend to be as picky on, just because by their very nature, they don't have a complete apex. It does help if it goes with the overall trend. But another thing that you may want to keep an eye on is occasionally you will see a triangle that doesn't work out. In other words, like an ascending or a descending triangle that fails. It goes in the other direction. Well, quite often that's either reversal of the trend, longer term, short term, depending on the chart, but it shows you that something has fundamentally changed with the attitude of the market. So keep an eye out for that. That's a little bit more advanced and convoluted, so I won't go into it here, but it is certainly something that you will notice over time that, sometimes they don't work. You've got a perfect descending triangle, for example, and then you break to the upside. Well, a lot of times traders would treat that as a wedge. In other words, they try to take out the top or try to trade to the top. Looking at this, I see a argument for a nice triangle here. Again, the wick did dip down below, but we have the triangle left. We broke to the upside. We hit there. So even if you were trading this as a wedge, which you could make an argument for that as well, either way, your target was hit. The height would have been about $3. So from 104 to 107 is what we're looking for. So right there would have been your target either way. And of course, there was resistance in this messy trading over here. So there's a lot of different reasons and a lot of different ways to trade these. But as you can see, the one common theme is it gives you a nice measuring stick. It tells you where the market, quote unquote, should go. And the great thing about that is a lot of traders use this methodology. And in fact, there are traders out there who trade nothing but triangles and wedges. So that is a consolidation pattern that is quite common. A lot of traders use it. It's very easy to use, very easy to spot. Like with all things technical analysis, the higher the time frame, the little bit more reliable it's going to be. But clearly, this is a well-studied and time-tested pattern that people use over and over again. And I invite you to look at any chart, any time frame. You will see these occur time and time again.